You want to put your deck up? Hi, everybody. Thanks for joining us today with another episode of Family Office Insights. We're really happy to have Andy Bernard back for a second time to talk about his opportunity in real estate. Really a fascinating session we had last time, not just because it's a compelling opportunity, but all the work that went into making it a compelling opportunity and uh, the oftentimes you get people who are sponsors who haven't gone hard on properties and everything in the portfolio is owned by them. So it's super interesting. And so I think you'll enjoy it. Thanks for joining today and sharing it with others. Um, and as I said last time, if there's anybody you know that you feel would be interested in what you hear today, you're most welcome to include them and be put them in direct contact with Andy. And of course, if you're interested, do the same. So, Andy, thanks again for doing this.
Thanks, Arthur. It's good to be back. I enjoyed the conversation last time as well.
So let's first start, if it's okay with you, of what the ask looks like,
Sure.
and then we'll go into the deck and the details a little bit more.
You got it. We are raising $152 million LP fund to invest in five distressed historic office buildings that we own as the GP to transform them into luxury hotel and multifamily.
And one of the things that is often asked, and you have a good answer to, so I'm setting you up, is
Okay.
that there's a significant GP commitment on this as well.
Yes. So we are committing $27 million on top of the 152, which is equivalent to 15% of the equity required, which is anywhere from, I don't know, 10 to 5 times a typical GP commitment.
Yeah, easily. And then is it fair to ask, and we'll get into the details because the deck is really good about the details,
Sure.
but is there some sort of uh, comment you can make on about how much debt you're going to need on these in aggregate as a percentage of the
Yes.
total funding?
Yep. We underwrite anywhere from 60 to 65% leverage from a construction loan standpoint, which is then underwritten to be refinanced within 6 months post completion of the project in a cash neutral fashion. So the point is the debt underwriting is conservative relative to what, in fact, we've already been able to achieve on the first of the five projects where we got a 70% leverage loan at a great price.
Yeah. Is that uh, debt something that is market, or there were some interesting ways that you were able to get that good price debt, right?
Yeah, there are two projects that qualify for a federal finance program called RIF, which is high leverage, long-term cheap debt that is assumable. So you can get a loan up
And
to
it's really
75%,
long too. Like the duration's really long, isn't it?
35 years.
Yeah, it's crazy.
35 years. And so,
Yeah.
yeah, two of the projects are qualify for this very cheap. It's priced at the 30-year treasury rate plus 1 basis point, not 100 basis points, one. So that's 5% fixed rate money for 35 years, which we can then hand to whoever buys the asset from us and
Yeah.
hopefully extract a pricing premium in return for that.
As a result. Yeah. Right. All right, let's get into the deck. There's lots of good
All
info
right,
in there.
let's see here.
Should be all set.
Okay, so what is Left Lane? Just to briefly say it, we are a vertically integrated real estate development company, fund manager, and hotel brand uh, creator and operator. We are focused on independent luxury hotel and residential, and we think that those two product types are actually converging in the space of hospitality more broadly. This is the exec summary that essentially Arthur and I just walked through, but just to hit the key points again. It's a $152 million LP raise. The purpose of the funds are to convert five distressed historic office buildings that we already own and control into market leading hotel and resi. The markets are high growth secondary cities that we spent a lot of time identifying as having excess demand relative to their supply, had a wonderful, walkable, vital downtown where we could buy things cheaply. So Phoenix, Pittsburgh, Providence, Memphis, and Savannah are the 5 markets. The returns are a 3 times multiple and a 30% IRR at the deal level, portfolio level, which nets LP investors at 2.5 and a 25%. On screen now are the 5 projects. And again, just to reiterate, if you invest in this fund, you are investing in these 5 projects specifically. Sponsor, Left Lane, we do not have the ability to do anything outside of this. It is a pre-specified identified pool. You can think of it as a seeded portfolio or a programmatic JV into these 5 projects. In terms of their composition, what will they be when we redevelop them? Savannah will be a 220 key hotel. Memphis will be 170 multifamily apartments. And these 3 projects in the center are mixed use, both hotel and multifamily. Arthur, any questions on the portfolio before we get into some of the nitty-gritty?
Just, and I don't remember exactly, so forgive me, but the entry point on this is if they were buying it at the beginning.
That is correct. We are allowing investors to enter these projects at our cost. Said another way, we're not charging a markup or a step up in basis, despite having spent several years acquiring and de-risking the assets. So, I said this last time and it remains true. I think this is the most important slide in the presentation. And the reason I say that is really about positive convexity or downside protection relative to the relationship between the downside and the potential upside that exists largely because of our cost basis. So I'll take you through the slide column by column. On the left-hand side, we are presenting the minimum cost per foot if we were to develop a luxury project from the ground up in our markets today. It would cost us at a minimum $750 a foot. And when you break that $750 into its, major components, $30 of that would be the land cost, and about $325 a foot would be the core and shell. So we're just looking at the pink part at $355 a foot. We have acquired this portfolio for $80 a foot. So we've compressed the land and the core and shell by 85% to get to this acquisition price.
Yeah.
And that was all through our distressed sourcing methodology that we built here at Left Lane. Interestingly, because these are historic buildings, and some of them are so iconic in the cities that they are in, we have been able to get our hands on another $70 a foot of grants and historic tax credits, which further reduce our basis. All of this ends up with Left Lane delivering a portfolio of 5 newly refurbished iconic buildings for a basis of less than $500 a foot. And if you've ever renovated anything in your home, that is a cheap number. And it's, the slide is saying it's a 36% discount to this.
Yeah.
But I think what's actually most compelling is that because this cost basis is so low, when we go to operate these assets, we can miss the underwriting that you see in the presentation by 40% and still break even.
Yeah. So that's the compelling downside protection.
That is it.
Yeah.
The next few slides focus on the 4 areas of financial incentives that we have as your friendly neighborhood GP set about to get for the benefit of the portfolio. So I'll take you through each one. The first financial incentive are what's known as historic tax credits. This is a federal tax credit program that has been in place since 1976. Its purpose is to incentivize real estate investors like me to retain and invest in the historic buildings in our downtowns across the USA. The way that it works is that you have to get approval in 3 stages from the Parks Department. That's who administers it. The first step is to get your building on the historic register. All 5 of our buildings are.
Were any of them on the register prior?
One.
Yeah.
The second step is to work with the Parks Department, really just to show them your renovation plans, your drawings, and they review them to make sure you're not going to destroy the historic nature. We have no interest in doing that. It's been part what makes these such lovely luxury hotel and multifamily buildings. So you get your Part 2 approval, and at that point, you work with the tax credit accountant to arrive at your tax credit value. Your tax credit value has 2 pieces. The federal government will give you 20% of whatever you spend on the renovation as a tax credit, and then each state has their own program. Once you get that number, you sell it to a tax credit investor. You run a competitive bidding process. It's a very large and liquid market, and your buyer pool primarily consists of corporations that are looking to lower their corporate tax rate. So they will pay you typically 10 to 20% of the proceeds when you begin construction, and then they'll pay the balance when you complete. And we'll use our Savannah project as an example. So on this underwriting for the Savannah deal, you would see that we've got 3.2 million tax credits as a source of equity. That's that first payment. And then when we complete, which by the way, will be in August of this year, the tax credit buyer will pay us $18.4 million. So on a $122 million project, we are receiving $21 million in cash to fund and defray the cost basis of the deal. And that is why that payment post-completion is the structural reason why the IRRs and the cash on cash returns are as high as they are.
Yeah. So what does it add? Like 800 basis points?
Of return?
Yes.
It's interesting. I haven't thought about it like that.
Yes,
It
maybe not a
does
fair
really.
question, but you get my point, right? It's like,
Yeah,
okay,
it's significant, right? It's probably, I don't know if it's quite 800, but it's
yeah,
probably, 3 to 4
yeah,
from an IRR perspective.
yeah. And just
Yeah, go ahead.
real quick, what's the delta between the value of the tax credit and what you sell it for?
Yep. So the market for selling tax credits is anywhere from 80 to 90 cents in the dollar.
Yeah,
The reason for that is the tax credit buyer has to utilize them over a 5-year period of time. So they discount them back at a rate.
yeah.
We underwrite 82 cents in the dollar. On that first Savannah project, we got 86. The second area of financial incentive that we have been able to achieve are property tax abatements. So in every city that we are operating in, we've acquired these buildings in, we've gone to the mayor's office and worked with the city council to negotiate a property tax abatement. And the reason for that, the reason the cities are open to it is because they believe that redeveloping a beautiful but functionally obsolete office building is going to generate taxes and jobs. And as a result, they're happy to give an investor like us an abatement on the property tax over anywhere from a 7 to 20-year period of time.
And it's
I'll go to
meaningful, right? It's a meaningful number that you don't have to pay for 7 years, for example.
it is, and I'll use this project as an example. In the city of Pittsburgh, there was a cap, a limit on the property tax abatement you could receive per project. But it was sized for real estate projects that were much smaller than this one. This is a 430,000 square foot building. So we worked with city council to write new legislation to remove the cap for projects downtown. That change, the removal of that cap on property tax abatement, adds $800,000 a year of NOI to this project over a
Nice.
20-year period.
Yeah. The rest of the
Significant
developers
value.
in the city must appreciate you did that.
I haven't gotten and bought a beer yet, but I'm going to Pittsburgh tomorrow, so we'll see.
Yeah.
Uh, the third area of financial incentive that we've been able to find are redevelopment grants. And I'll just stay on Pittsburgh because you'll see $10 million here as a source under local grants and incentives. We spent about $40,000 lobbying to receive this $10 million grant from the state of Pennsylvania. It is simply free equity in the project. It's the largest redevelopment grant the state has ever awarded.
And
And
it's
again,
real
it's
money.
because of the iconic nature of the building. I mean, this was the headquarters of Gulf Oil when they built it in 1932. It is Pittsburgh's Empire State Building. It's just the marquee asset in the city.
Yeah.
Um, the last area of financial incentive is the federal debt facility that we spoke about up top. So I won't repeat it all, other than to say it's long-term, fixed rate, cheap debt that is high leverage, and the best part about it is that it's assumable. And we do have it, or the ability to get it on Pittsburgh and Providence. We also introduced legislation in Congress. It's just another thing we do as a GP, try and lobby. The legislation had bipartisan support. It's making its way through committee. It would expand the eligibility such that our other projects would qualify for the debt. I don't know if we'll be successful, but we're trying.
Yeah. It's hard to, once you get involved in the legislative process, it's really hard to determine the outcome because sometimes the incentives don't make sense. There's other agendas, right?
That was really well said. We don't know all of the things that are happening, behind closed doors that are driving decision making.
Yeah. It's the old sausage being made program.
Yeah. Uh, the meat or the center of the presentation is a one-page summary of each project, its sources and uses, its return profile, and cash flow summary, as well as some highlights about why it is well located or in a market that's undersupplied, and we've built a moat around our business, or the growth factors that were driving the outside demand that we saw.
Can we go
I should
back?
point out.
I'm
Mhm.
sorry, go ahead.
I was just going to say, we've created two of our own hotel brands. One is called Bardo, that is our luxury brand. Our second brand is called Recess, which is our lifestyle brand. So the way to think about them positioning wise is that Bardo will be the number one most expensive hotel in whatever city we're in, and Recess will be number three or four. And it's all about where do we see the demand. This will be a Recess hotel. And this again, we finished construction in August. We open the hotel in September of this year. Pittsburgh, mixed use, 130 key Bardo hotel, so a smaller one, and 230 multifamily units. Pittsburgh is an interesting city in that you've got incredible growth, largely as a function of the medical system, it's one of the largest in the US, but also the education that's there. Carnegie Mellon, just being one example, has the best and largest AI program in the country. And as a result, all of the major tech companies have found and created and are growing office space here. So people are staying in Pittsburgh, which is fascinating.
And PNC is still there too, right?
It sure is.
Yeah.
This is called the Turk's Head Building in Providence. This will be also a mixed-use project with 155 keys, 44 multifamily units, much of them furnished. The logic on this project is that obviously it's a gorgeous building, looks like the Flatiron building we bought very cheaply. However, it's got 5 universities in a very tight geographic area. And the universities four of the five happen to cater to on a relative basis, affluent students.
Yeah.
And the students' parents pay exorbitant rents to house their children outside of the dormitories, which is why you see $4 a foot multifamily rents here in Providence. And when you look at the product that is getting those rents, you would be shocked because everywhere else it would be $2.50, $3 a foot. So, great little market, completely overlooked. I think people think of Providence as in the 80s and early 90s, it definitely had some crime and graft issues associated with it. But since really right before the GFC, it's been a great place to do business.
So it's Brown. What are the other ones?
Brown, RISD, University of Rhode Island, Johnson and Wales, and I always forget the fifth one.
Yeah. My niece went to RISD.
Oh, nice.
Yeah. So
The next
can we
project,
can we
yeah, go
step
ahead.
go back on that one for a second? Because what I
Sure.
found really fascinating last time, and I think the audience would appreciate it, is that you look at this building and you go, "Oh shit, the air conditioning, the electrical, the plumbing, it's got to be ancient." Can you talk a little
I'm
bit how you mitigated that problem?
really glad you brought it up. Key point to this entire investment thesis. So bear with me a minute. I'll take you through it.
Yeah.
Construction costs since 2016 have escalated so rapidly that today and over the last few years, most ground up construction projects do not pencil. You
Yeah.
cannot earn a return that you would require to take on development risk. So, as we were devising our investment thesis, we knew we wanted to avoid, to the largest extent possible, the trades that have been the biggest offenders in that cost escalation, which are namely concrete, steel, and glass. So when we selected the buildings that we were going after, we went through a multi-phase identification and then vetting process. On the identification front, they had to be historic because we wanted the benefit of historic tax credits and beautiful iconic buildings. They also had to be well located enough to become a luxury asset. But the third characteristic that every building had to share was that it was the right size, meaning big enough, and shape to be renovated into a hotel or multifamily project without changing the building structure. Meaning, we're not doing projects where we have to add floors or where we have to move structural walls around. It's too expensive and too risky. Interestingly, I mean, there are a lot of reasons why historic buildings made sense, but one of them was that they were built before the advent of central air conditioning. So the buildings had to be shaped in such a way that the interior spaces got great natural light and air quality. If you were to, contrast that with a modern office floor plate, which is a giant rectangle,
Yeah.
40,000 square feet,
Yeah.
you would have to cut out the center of this building if you wanted to have apartments facing out and then a corridor and apartments facing in, which you would have to
Yeah.
do because
Nobody
otherwise
wanted the
it's too deep.
inside.
Yeah. So none of our buildings require structural change, number one. Number two, once we get a building under contract, we spend 3 months going through due diligence period where we are inspecting the key risk areas of the building. And they are the facade. Does this entire building need to be repointed or not? The window package. Are these windows operable and in good enough shape? They don't require much investment. Number two. Number three, the roof. Is it leaking? What's the condition of the water tower, and how is that flowing down? Four, we scan the interior of the building and do selective demolition so that we can understand if we're dealing with mold or asbestos. But the interesting thing about office as a real estate product is that office lease terms are typically 5 to 10 years. So every 5 to 10 years, every tenant, if they're not staying, is moving out. A new tenant is coming in, and that means the landlord is ripping everything out down to the studs and building a new space, or the tenant is doing. So actually, a lot of these buildings are quite clean. But the final risk area, which is what you asked me about, sorry, it took so long to get there,
All right. Yeah.
is the mechanical, electrical, and plumbing systems of the building. This is where a lot of developers get into trouble. This is where a lot of the, conversion boogeymen come from, because investor will say, well, I'll be able to reuse those elevators or that electrical wiring, and then they find out they can't.
Yeah.
Arthur, we start by assuming we have to replace all of it. We carry $140 a foot, and if we find out down the road that we get lucky and we can reuse some, then great, we've saved some money. But if the deal does not pencil without that fully baked budget for MEP incorporated, then as an investment committee standard, we do not move forward with that project.
It must be really an enormous amount of work.
It took
And
us, so we started deploying capital in 2022 or late 2021 to begin building the portfolio. Yes, it takes a lot of work, but Left Lane, is a 22-person organization, got three verticals in-house, the investment vertical, the development vertical, of which there are 8 architects on our staff. Everything we do is very design forward because you get paid a premium return in luxury hotel and resi for good design. But we also have to make sure we have the experience to contend with the challenges of renovating historic buildings, which we do. I'll just flip through the last couple. Phoenix is the punch card building. It's actually 3 buildings, these beautiful 6,000 square foot rotundas, and the tower in the back. This will be another mixed-use project with 209 key hotel and 127 multifamily units. Interestingly, Phoenix as a market, if anyone follows commercial real estate, has had an oversupply of multifamily. However, it's only been in the commoditized multifamily space. So think cheap 3/1, 4/1 stick-built product. At the high end of the multifamily market, there has been zero, particularly in this part of Phoenix. So that part of the market remains extremely healthy. And oh, by the way, we're only delivering 127 apartments, so it's a relatively small portion anyway.
where in Phoenix is this?
This is at Osborne and Central. So it is 5 minutes north of downtown, 15 minutes southwest of Scottsdale.
Scottsdale, yeah. Yeah.
Lastly is our multifamily project in Memphis, Tennessee. This is called the Falls Building. It's a beautiful 1910 building we bought for $54 a foot from a distressed seller, like all the others. It sits just to the right of the building is the Memphis Law School, and on the other side of the law school is the Mississippi River. So you've got great views. There is no multifamily building in Memphis that will have comparable amenities or views, which is in part why we expect this to be the leader in the market. You got great growth and demand dynamics at the high end of the market in Memphis, and that Elon Musk has just started a battery plant there. FedEx moved part of their corporate headquarters downtown. St. Jude Children's Hospital is, I think, 3 years into a 10-year expansion where they're investing billions of dollars in and around the city and bringing a lot of high-paying doctors and nurses to the market.
So this is a architectural rendering.
It is exactly.
And I'm not going to ask you to show us what it looks like now, but is this much different than what it looks like today?
No, it's really just the lighting in the building that
Yeah.
the renderers did. The building looks like this.
Yeah.
There's some pages on our team, but probably important to spend some time on the structure of the fund and then the associated fees and waterfall structure. So at the top of the page, we have a table that illustrates the GP equity commitment per project and then total LP debt, tax credits, and then total cost. So the headlines are, again, it's a $700 million portfolio. We are contributing 15% of the equity. We're raising 85. You can also think about this, even though it is in a fund structure, as a programmatic joint venture between us as the GP and our LP fund. Does that make sense?
Yep.
All right. So let's talk about the term sheet. The headline is that the way we have structured the fees and promote are very investor friendly, meaning friendly to you. Big GP commit number one, which we talked about. It's a 7-year fund with 2 1-year extensions. On the management fee side, we have almost completely eliminated the J curve. And there are 2 reasons for that. Number one, we're only charging a management fee on deployed equity, not committed. And number two, we've owned these projects, as we've talked about, for so long that all the equity will be deployed within 12 months. They are already almost completed or in various stages of completion. We're not charging a step up in basis, which we talked about, and then the promote structure. So what we've done is to say that all 5 deals are crossed, right? The LP and the GP earn pro rata returns until the portfolio has achieved a 1.4 times multiple. That is the first hurdle. That is a very high initial hurdle. It's equivalent to
Yeah.
about a 10% IRR. And then the GP starts to earn a promote as we cross through these tiers you see on the page. 1.6, 1.8, 2.0, above a 2.0. But the thing that I want to make sure that I highlight is that we, the GP, make most of our money, more than half of the promote, only if the portfolio does better than a 1.8. It
Yeah.
is back-ended. So we're trying to protect our LPs from paying fees on mediocre returns, number one. And number two, telegraph to you that we think we're going to absolutely crush it because that's where
Yeah.
we make
Kill
our
it.
money. It's at the
Yeah.
back.
Yeah. So is the 6% promote on the entire upside, or is it on that amount above two?
No, amount above. It's
Yeah.
incremental.
Yeah. Yeah.
And
So
lastly, we do have a minimum 8% IRR test, meaning we can't get into this multiple-based waterfall unless the portfolio has achieved at least an 8% IRR.
yeah. How have you financed the work that you've done up to this point, securing the property and then doing the work that you've been able to do so far? Is the GP equity been enough for that, or do you have debt incrementally on some of these?
It has largely been enough. So we have a substantial GP equity pool. We have put on some small, relatively inexpensive bridge debt in certain places. We got a little $10 million loan on the Pittsburgh project. We got great seller financing on our on that Savannah deal. It was at the AFR rate until we put the construction loan on. Um, the Providence project is cash flow neutral. It's got a little bank loan on it. And then Phoenix, we do not have any debt. I think, and Memphis, we do not have any debt. We bought all cash.
So this is more than enough for anybody to do, even within an organization your size. Uh, what's the next thing? Is there just another fund with 5 more, 10 more, depending on whether you can find them or not?
Mm. So the next fund will look more like a typical commingled blind pool fund, with the exception of the fact that we'll seed it with a few projects that we've already got percolating in the background.
Yeah. And do you
But they will
think,
not all be distressed historic office. Uh, the reason, as I mentioned, that we focused on this is because of how crazy expensive construction costs had gotten relative to the upside. That'll change over time, right?
yeah.
So the next fund will likely have some ground up development. It'll have some distressed acquisitions and redevelopment. It also will have uh, some deals that are more down the fairway, lipstick on a pig renovations that aren't so intensive.
Is it the intention to have in that portfolio an expansion of the 2 hotel brands?
Yes. Our goal is to get the brands to 15 to 20 assets.
Yeah.
We think that's where the demand probably peaks out, and it'll take us a long time to get there.
Yeah. What do you think uh, the is it 3 years to construction cost level? I know it's hard to prognosticate, but saying that that'll change is true. I think that's
Hmm.
safe. But is there any, do you have any view on how whether that's going to get better in the short term?
Well, there are so many competing factors because you just take tariffs as an example.
Yeah,
Uh, the headline news on tariff for construction is terrible, right? However, most vendor contracts that we enter into shift most of the blame or most of the risk
risk.
for
Yeah,
something like that onto the vendor.
yeah.
So we actually didn't have much of a change construction cost wise on our Savannah project that, when we were buying things, this happened because we had structured our contracts to deal with that. Now, take it a step further, it's one thing to have the contract say that. It's another to be sitting across the table from a guy who's like, look, I know that's what the contract says, but if you make me eat that, I'm out of business.
Yeah, you're gonna put me under. Yeah,
Right.
totally.
So then
Yeah,
you gotta find a way to figure it out.
yeah,
But I just saw a statistic on construction volume. A much larger portion of construction activity over the last year has been around data center construction.
yeah,
And so that's really sucking up a lot of the supply of labor and materials. Um, so I don't know if you're going to see. Look, I've never seen construction costs go down. It is about a slowing of the acceleration
yeah, yeah. I think that's a pretty safe bet.
and waiting for the top line to catch up.
So you asked me before we got on about some of the stuff that we're seeing, and one of the things as it relates to data centers is decentralized data. I mean, even NVIDIA has just announced that you can put a solar roof up and put a mini data center on the
Hmm,
side of your house that looks like
really?
yeah, it looks like a just a big electrical panel, and you can sell it into the grid or you can sell it to the cloud compute. And so that is
That is amazing.
yeah, and so that is one. And then there's another longtime friend of mine starting a company uh, that's 2 years into it now called Electra, which he's doing exactly the same thing, except it's a box this big that you plug into the wall and take your current solar panels and sell it into his cloud instead of back to the grid for compute.
Amazing.
And so that those are only two small things that suggest that even though the data centers and the demand for compute is not going to change much, there's other ways for people to participate, right?
Yeah,
Super interesting.
I think it's very smart.
Yeah. So,
Cool.
all right. Well, thanks for doing this again. We're gonna
You're welcome. One more thing I just want to hit.
please, yeah, whatever you want.
We are closing this fund on June 30th.
Yeah, I was going to ask you the duration, right?
So if anyone out there who's listening has interest, please get in touch with me soon, this week, next week, so we can begin your diligence process. And if you are able to get there in time, that would be great. If not, I guess we'll see you on the next fund. I just wanted to point out that the fund is closing in a relatively short period of time.
Yeah. How far along are you on the non-GP commitment?
More than two-thirds.
Yeah, good for you. Excellent.
Yeah,
Okay. All the more reason to urgently get into the data room and so forth. Yeah.
for sure.
Yeah.
All
All right,
right,
everybody.
Arthur,
Thanks for
thanks so
being here.
much.
And thank you, Andy,
Oh,
for
any
doing this.
questions in the chat or anything that we should?
I covered most of them. Yeah.
Okay, great.
Yeah. Great.
Cool.
All right. Thanks for doing
Thank
this.
you.
Talk to you soon, everybody.